What's going on, everybody? TG here, back with another video, and we're going to be talking about Teladoc Health, a stock that Cathie Wood and ARK have been buying up a lot on this dip. And I wanted to break down a couple things about this company, what they do, are they worth investing in, how much is Cathie Wood buying, and the main question, should you be buying? So we're going to break all that down in this video. If you guys are interested and want to help out, make sure you like and subscribe. It would mean a lot to me. But let's just jump right into this video. Arguably one of the most exciting companies in the healthcare arena over the next decade, Teladoc Health, as the name implies, is a leading provider of telemedicine services in the United States, and is no wonder why Cathie Wood and ARK have purchased so much. This is in a growing and expanding market that is set to take off over the next couple of years and really disrupt the way Americans use healthcare. Teladoc is the third biggest holding of ARK and currently has a weight of 6.3% out of the entire ARK holdings. Cathie Wood clearly believes in this and thinks this is the most innovative telehealth stock there is. She currently owns 7.9 million shares and has been buying shares on this dip the entire time. Only a couple months ago, she only had about 1.2 million shares. Now she's sitting at 7.9 million, the most the fund has ever held. So why have investors been fleeing Teladoc for the past couple of weeks? Well, there's two reasons. First, the dozens of high growth companies have been punished as the NASDAQ got sold off because of those treasury bond yields and interest rates increasing and all that good stuff, where all basically Teladoc and high flying companies got hit hard. Second is Amazon. And you guys know me, I'm a huge Amazon bull, but Amazon announced plans to take its telehealth platform, Amazon Care, nationwide. And Amazon has deep pockets and is a well-known brand. So this announcement clearly worried some people and especially investors. However, there are reasons to believe that Teladoc's ascension as the nation's leading virtual healthcare service provider isn't just some fluke. Although the skyrocket in visits of 10.59 million from 4.1 million of last year has been because of the pandemic, it is worth noting that telehealth's revenue averaged growth of 75% annually between 2013 and 2019. So even before the pandemic, they were still growing on a fast rate. Speaking of rates, I also wanted to go more into the realness behind telehealth and the rates that this can continue to grow over the years, because it is a real thing and telemedicine is an expanding market. The momentum behind telehealth is real and it's here to stay. And it's more convenient for the patients and allows physicians to keep better tabs on chronically ill people than, the general office visits that we have. Lower initial costs and the ability to provide potentially costly longer-term healthcare for chronically ill patients makes telehealth's platform one that health insurers will gladly promote. Now, of course, we have to talk about a company's fundamentals, because at the end of the day, a company is only as good as how much it's worth and how much the company is actually going to be worth one day, based on a number of things such as revenue, growth, profits, and all that good stuff that comes in the earnings. First off, let's look at their market cap. Currently sitting at 27.91 billion market cap, a pretty high market cap overall, but their earnings last quarter for quarter 4 of 2020 were pretty good. We had revenue of 383 million, which is 144% year-over-year growth. Unfortunately, giant losses of 393 million, which obviously really hurt the company considering the fact that it was their biggest loss ever, but it was also their biggest revenue ever. So they're getting more growth, but they're also losing a lot of money, which worries a lot of investors. Company's currently trading at about 24 times trailing revenue, so that's obviously very expensive. That's about 9 times as much as the average S&P stock, and about 2.5 times as much as even ARK's holdings are. So obviously it's a little alarming. It's not a cheap stock in the slightest, but it's all about what it's going to be worth and how big telemedicine is going to be, and if Teladoc is going to capture the majority of that market share. We talked about Amazon being a big threat. There's also threats from other emerging companies as well that could take away market share from Teladoc. So the question comes down, is it worth investing in? And if so, how? Well, personally for me, I would sit back on the sidelines for a little bit. Personally, I'm a little worried about its valuation. I think it's very highly valued. I'm not going to say overvalued at the moment because we don't really know what it's actually valued at. We just know it's valued very high. So I think if you're going to take an approach in Teladoc, I think your best bet is going long term on it. If you really want to believe in it long term, I would honestly sell puts super long term on it. and be safe, because we don't know where this company is heading. It's valued at a very, very high multiple, significantly higher than, even ARK usually invests in. ARK's very normal to invest in high growth companies and high multiple companies, but this one obviously exceeds that. So the question is, what should you do? Well, personally, for me, I'm not a financial advisor at all, but personally for me, if I'm going to take this approach, if I want to take a bet on Teladoc Health, I want to do it in a safe way. I want to be a little safe on it. So what I'm going to do is I'm going to go long term, at least January of 2022, and I'm probably going to sell a put. I'm probably going to sell maybe $175 strike price put on it, to be honest with you. If I'm going to be safe on it, that allows me that even if Teladoc struggles for the next couple of months and goes down, well, I'm still protected. And worst case scenario, I buy Teladoc at $175 a share, but I get paid $2,600 to buy, so making my break-even price at $148. That's if you're a little bit concerned. If you're bullish on it, I say you go ahead and you sell a $200 strike price for next year. Your break-even price is still well under what it's at now, and you're being able to pick up shares if it goes to 200. If it blows past 200, all right, well, you made $4,000, to not do much. That's a pretty good percent return right there. Worst case scenario, the stock falls hard, and well, at least you got paid to buy those shares. You're not buying it right now at 183. You're technically buying at 159, which is significantly lower than what it's currently trading at as of right now. I just think calls are too risky in this market, especially with these wild drops that we've had. You have one bad day, you can get hurt quickly. Even on some of the longer out calls, they're expensive, especially on a high company like this. If you want to buy a $200 call, you're spending almost $2,500 just to buy that call. So I think your best bet is probably to sell a put on it if you have the capital. If you want to buy 100 shares, if you don't have 100 shares to buy, I recommend doing a long-term put credit spread. Maybe choosing the 175, 170, getting paid, $205 for one contract to risk 500, saying that's going to stay above that. I think that's pretty safe. You can go ahead and sell a bunch of them because you only need 500 of collateral to even sell that. So that's personally what I'd be doing. I think personally I'm not going to be touching it just because I'm in Amazon already, and I have that exposure to the healthcare system and the whole telemedicine stuff. So I do think it's a good stock, though. I do think it's an innovative and revolutionary company, but it's just about what it's worth, what it's worth right now and what it's going to be worth in the future. And I just don't see it being worth as much right now if competition continues to be a looming threat, which it very well is. So I like the company overall, but at the current price, I'm not willing to buy it. 150s, I probably would. I'd probably sell a put on it, or a long-term put credit spread, but at the current evaluation, I'm just not comfortable buying it. But if you want to take that risk, it's definitely a stock worth taking the risk. The implied volatility is high on these, and you can take advantage of that and make some good profits on it. So that's what I'd be doing if I were you guys. Take advantage of the higher implied volatility for these ones, but in the short term, it's a little risky. But that's just my thoughts. If you guys like that or agree, make sure you like and subscribe, and let me know what your thoughts are on Teladoc Health. Anyways, guys, have a wonderful day, and I'll talk to you guys next video. Bye.